Gut Rich Slow with John Wolf. Hey, today I'm going to talk to you about PMI. And you should just know up front the P stands for privilege. Let's go over that. So first, there's all my license stuff if you want to get a hold of me. And let's just talk about it. So if you were going to do an FHA loan, the PMI percentage is 0.85. But today we're going to talk about conventional loans because that's what a lot of people do. And it's the type of loan where people are really concerned about doing a bigger down payment. So let's talk about if a bigger down payment is a good idea, makes sense, or if it's worth delaying your purchase. All right, so I just ran mortgage insurance rates for my company. My company actually has really low rates. So my company's rates and someone who had a 740 credit score who's putting different amounts down in my neighborhood. And it's one person on the loan. If there's two people on the loan, you actually get a discount. So anyways, if this person put 3% down, and by the way, the purchase is $556,000 because I wanted to give you a monthly number. So that's what I'm basing on. So the purchase price is that, then they put 5% down. So the mortgage insurance rate, somebody with decent credit, 740, is gonna pay 0.54. What's 0.5? What's that actually mean to you? So basically you take the loan amount. So if the loan was $100,000 and you times it by 0.54, and then you divide that off monthly, and that's what the monthly mortgage insurance payment is going to be. And on a conventional, unlike an FHA, this number just stays the same. You make the same monthly for 5, 6, 7, 8, 9, 10 years, however long it takes to get down to that below 80% loan to value ratio. And then it just drops to zero. But you see, if this person on this $350,000 purchase did 3% down, they're going to pay $162 a month. Other thing to mention, if you're putting 3% down, your interest rate's also going to be higher until you get to 5%. So at 5% down, the mortgage insurance rate goes down lower because the mortgage insurance company has to cover less, and the interest rate actually goes down meaningfully as well. So if you're somebody who can do 5% without killing yourself, but you just kind of want to do 3%, we'll do the math together and see what the best plan is for you. A decent amount of the time, doing 5% saves you enough money that it's worth that extra reach. But often if it delays or makes it so you can't buy a home, you don't want to do it. We just kind of have to consider things on an individual basis. But here, the mortgage insurance rate goes down to 0.38, and then that monthly payment, again, monthly payment on a lower loan amount because you're putting more money down, is going to be $113. Is that real money? Absolutely. Is that a ton of money? No. Okay, let's say you put twice as much down. You put 10% down. You're really going in on this one because 10% down on a $350,000 purchase is going to be $35,000. Wow, so putting half that down is a lot easier for most people. Well, what's that do to the monthly payment? Well, it was basically $111. Now the monthly MI payment is only $72. That's not a lot less. Well, no, it's not a lot less because really the mortgage insurance amount isn't very much. Let's take a look at 15% down. So if you put 15% down, and now you're putting some serious money down, we are looking at 0.13%. That means you have to pay 0.13% of the entire loan amount every year, and that's only $35. Well, that's not a lot of money. 20%, the MI rate is NA because you don't pay mortgage insurance. Now, there is a rub. So do you remember how I told you that if you put 3% down, you pay a higher interest rate than if you put 5% down? That's true. And most people know that. It makes sense to most people. What doesn't make sense right off the top is that actually if you put 20% down, you pay a higher interest rate than if you only put 15% down. Why is that? Well, the mortgage insurance covers a percentage of the entire purchase to protect the initial investor. And if you put 20% down, you don't have to have that mortgage insurance. So the only place the investor can get their money back if you somehow foreclose in the future is to foreclose on you, and they can only get what money's there. But if you put 15% down, they actually can get not just 20% of the value, they can actually get 25% because that mortgage insurance covers 10% of the purchase. So you put 15, mortgage insurance cover 10, that's 25%. Now you get the same interest rate again if you put 25% down, but how many people can easily put 5% down who can't put 25% down? I mean, that is a world of difference. Anyways, have an awesome day. I'm John Wolf. I'm a loan officer here in Oregon and Washington. If you have questions, let me know. Take care. Bye.